Hello, everybody. My name is Michel St. Pierre, and this is Valhalla Mortgages. Thank you so much for clicking. This video is all about lending for business owners, people who run companies, business for self lending. There's a lot of myths out there, and we're going to bust through some of those myths today. That way, if you are a business owner or you know business owners who are struggling to get a mortgage, this is a good video for them to review. My contact information is in the link if you want to book a meeting with me for a mortgage consultation. If you do like my mortgage content, please click the follow button, click the like button, and comment. But let's get right to it now. Let's look at some of those myths that people have for business lending. One of the major myths is that banks look at business owners as high risk. They really don't. They just underwrite them slightly differently. And in fact, banks, both on the alternative side and prime lending, like your banks, like the top 5 banks, they have specialty programs for business owners only. So there are programs designed for business owners to help them get approved, whether it's grossing up the income on the A side and using corporate tax returns to bolster up your personal income, net worth on the A side, projected income, which is a big one. So if you're a brand new physician fresh out of school, they will actually state how much income you make. They have a policy saying you make X amount of dollars a year. Before you even get your first pay stub, they're willing to do something like that for you. There's a whole lot of them that way. And that's A side lending. Now, on the B side, for example, you have stated income policies, which is you stating your income. So if you say you make $100,000 a year and you provide bank statements and invoices in the structure of your business without tax returns, so they don't want to see an NOA, they don't want to see your T1 generals, so your tax returns, they don't want to see that. They just want to see that your business can support what income you state. You can't do that with the salary. You can't do that with a wage. So that's where business owners have a major advantage. And if you're doing a really low loan to value loan, like the value of the loan is low considering how much value your house has, you can do declared income, which is even less documents than stated income. So there's lots of options out there that aren't private mortgages, both on the A side and on the alternative and B side. So it's important to have your mortgage broker go over all these options with you to make sure that you get on the A side if you need to, or you qualify for a B deal to do that deal instead of just pivoting right to a private because you were declined in one place. So another major myth is my account screwed up. I can't get approved for my mortgage. So as we went over before, there are ways of getting approved without your tax returns, right? Through state income policies. So they don't want to see NOAs, they want to see tax returns, they want to see your business, how it operates. And on the A side, there are other ways of approving too, with standard income documents and then documents from your business to support additional income and gross ups. Your accountant's job is to save you taxes. It's our job to get you approved for a mortgage as mortgage brokers. You have to look at the global savings too. If you do want to get an A mortgage and you want to claim the amount of income required, well, you're going to have to do that for 2 consecutive years and has to be reasonable. So you can't have low one year and then really high the next year. So you're going to be paying more in taxes to do that, and it may be tax efficient to do an alternative deal through a B lender than go to the A side for you. These are all the things we have to go over with your mortgage. But yeah, your accountant screwed up. They're trying to help you save money. And a great accountant's going to do a really great job in saving you money on the tax side. It's our job to get you the mortgage that's going to work for you. So the next myth is I owe taxes, so I have to go to a private mortgage. That is not the case at all. There are alternative lenders, B lenders, that will do the stated income policy, the bank statements and the invoices and the structure of your business. You state your income. On there, you will mention that you do owe taxes, and the refinance will be used to pay out the taxes that you owe the CRA. Completely something that can be done. You don't need to do a private mortgage first. The only time you need to do a private mortgage first is if you can't get approved to the state income policy for other reasons, or if the CRA has locked your accounts and you need access to those accounts right away, then we would get a private mortgage involved right away to pay up the CRA and then go do the state income or an A-side deal, depending on what we need to do there. So yeah, 100% you can do this. You don't need a private mortgage all the time to pay out CRA first. Big myth, a lot of people get stuck paying extra fees and high interest because of that. You should always check out what the alternative lenders are willing to do. Most of the time it'll go through as long as you're a qualified buyer and qualified borrower. So another myth, sometimes I get paid in cash. I can't use that income towards my mortgage. On the alternative side, you can, as long as it's reasonable and as long as you're depositing into your bank account. So you're not keeping it under the mattress. Now, you don't have to do structured deposits like every time you do a cash job where you're getting tips, for example, if you're a masseuse, if you're doing cash jobs and you're like you work in trades, you don't have to deposit it every time. Ideally, that would be the best scenario, but that's tough. You can do it in one chunk a week, but make sure that you're tracking it too. Like track it on a spreadsheet, track it on a deposit book. That way, there's more to show the lender. Hey, these deposits at the ABM machine or the bank, these were done because of tips or they were done because of cash jobs on the side. We can use that income as long as it's reasonable for the industry and as long as it's a reasonable amount. So this is a big myth that people get hung up on a little bit because you have to do this properly. So my truck is for the business. The loan payment shouldn't be included in my mortgage application. So can you exclude the payment for a truck for the business if you had to have it personally guaranteed and it's on your personal credit bureau? You can. The only way to do it though is has to be in the business's name. So the truck's ownership has to be in the business's name and the payments must be coming out of the business account. And this is still an exception. It's not a guarantee. But if you want to have a chance at having that truck payment removed or that car payment removed, that's how you have to do it. So it has to be in the business's name and it has to be coming out of the business account. If it's coming out of a personal account, no go. If it's in your personal name, won't work. You got to get that transferred over to the business's name. And once again, I have to emphasize, this is an exception. Can be done, has to be done this way. If any of these things are not accurate, as in if the business name is not on the truck or it's not coming out of a business account, it's not going to go anywhere. You're going to have to pay that car payment is going to be included in your mortgage application there. So keep that in mind. So this is a myth that's circling around bad advice from mortgage brokers. Okay. If I claim more income last year, I will get approved, right? No. If for the A side, no. You have to watch out. 2-year averages have to be consistent. So if you want to be on the A side, you want to use the gross up policies or any, the 2-year average policies there where they look at your tax returns, they look at your NOAs. If there is an extensive difference between 2 years ago and last year, I'll give you an example. Let's say you had an NOA that said you made $40,000 in 2022, and then in 2023 you said you made $200,000. They're not going to split the difference between it. They're not going to do a 2-year average for that because it's unreasonable growth. So if you just claimed all that income last year to get the 2-year average to get approved, they'll decline that unless there's a damn good reason why it's so different. You've just basically paid an awful lot in income taxes to find out that you're probably going to still be on the B side of lending. So you have to speak to people who have a lot of experience in mortgages, especially mortgages for business for self, because if people are giving out that kind of advice, you've just paid a large amount in taxes that you didn't have to pay, and you didn't get to your goal of getting to the A side. Things have to be reasonable. That's going to be a word a lot, reasonable. So another myth, I have credit issues. I've had credit issues in the past. Now I'm stuck in a private mortgage. No, not always. They look at business owners, as I mentioned at the beginning, the same way they look at salaried employees, T4 employees. They look the same way. As long as you've corrected those credit issues in the past, B lenders, alternative lenders, and A lenders will still look at you as long as there's an explanation and as long as the credit issues are corrected and the credit rating is where it needs to be now. They don't hold it against you. People aren't perfect. This is part of my other presentation on first-time home buyers. People aren't perfect. Like the bank's not expecting you to be perfect. Lenders aren't expecting you to be perfect. Things come up in life that cause mistakes. If you fix those mistakes, take ownership and move forward, then you don't have to worry about those past credit issues coming to haunt you. As long as they're disclosed up front, as long as they're not discovered later on in the process, and all the cards are on the table and we have an explanation, then you have a really good chance of still getting approved. So keep that in mind. Honesty, being everything up front. So no, it's not going to instantly kill your deal on the A side or the B side or alt side there. So remember, the past is the past. It's how you handled the past that can get you approved. So another major myth, which we've already busted, is you can't be tax efficient and be on the A side. So if your accountant's really great at writing everything off, and you have really low tax, you have really low income tax, that you can't get approved on the A side. Well, there are programs specifically for that, right on the A side. There's insured stated income. So this is that 12-month bank statement. But in this situation, they want to see the NOA. They would only multiply your NOA by so much. So yeah, there is a limiting factor there, but you can still have some tax efficiency. There's Business for Self Plus programs, which they'll look over your corporate tax returns and your corporate documents to pull additional income from there to bolster up your income on the personal side. Also, there's like dividend income and all that. We can use that. So if your accountant is doing a certain amount of employment income and a certain amount of dividend income, and even if that number fluctuates throughout the years, but the total income is relatively consistent, and we can explain that away as just the tax efficiency aspect of it, then yeah, you can still be tax efficient, still have an A mortgage. There's plenty of options for you there. So another myth busted. So this applies to everybody, not just Business for Self clients. There seems to be this rumor going around, and it's not really inaccurate, but not everybody has a big credit bureau with many different products, right? I only have one credit card, I won't get approved. This typically comes up for people who've had credit issues in the past and they're cleaning them up and they want to limit themselves to one credit card. Now, ideally, lenders want two trade lines that are 2 years old that have at least 2,000 available. So two credit cards that are 2 years old with at least 2,000 available, ideally. But as we all know, and as I went over in the past, life doesn't exactly provide us ideal situations. So on the B side and also on the A side, things like utility bills, rent, and cell phone bills that are all pre-authorized from your credit cards or your bank statements and showing no NSF, no return payments, no missed payments, they can use that to bolster up your credit report. Doesn't get added to your credit report, doesn't increase your credit rating, but it can be used to support a credit bureau that doesn't have a large amount of trade lines. So that works on both sides. So another myth busted, and that's not just for Business for Self mortgages. This is for all mortgages in general. So another major myth is I've switched to Business for Self and I don't have 2 years of business under my belt. I'm going to be declined. I can't get a mortgage on the A or B side. I need a private mortgage. Now, not true, because if you switched industries, then yes, if it is the same industry. So let's say you were an IT professional at a bank, and now all of a sudden the bank's like, hey, we want to hire independent contractors, people who run their own businesses to our IT, and they hire you, and you're a brand new business owner, they will look at that and be like, well, you don't necessarily need 2 years because it's the same industry. So they'll look at your previous year's tax returns and what you have coming in as a new business owner, and you can get approved with those types of deals. So it's not always has to be 2 years. As long as it's been the same industry, you have consistent income over time, you can still get approved with under 2 years worth of Business for Self. And the final myth, now this is for purchases. I don't have 20% to put down on the purchase. I won't get approved. There are Business for Self programs for less than 20% down. There are. In fact, one of the more popular ones is the Stated Income Insured Mortgage Program, where if you have 10% down, they will look at your line 150 on your NOA, and they will look at your business banking statements. They will look at invoices and the structure of your business. No T1 generals, so they're not looking for that, only the NOA. And they will do a state income, as in they will state your income. This is a reasonable amount of income. You're a massage therapist. Your NOA says you make about 35,000, but 60,000 is reasonable. Here's all the statements to prove it. Boom. You fill out that form and then it's approved, right? There's a lot of options there. 2 years, and of course there's the standard Business for Self approvals, right? 2 years T1 generals and NOAs, the average of that, and then you can gross that up by 15% or 20% depending on the lender. There's lots of options for Business for Self people with less than 20% down. And once again, you have that special option of being able to state your income. So you can actually still be tax efficient, which is great, and create a reasonable state income policy for yourself and still get approved for less than 20% down purchases. So a lot of myths here busted. just on the slide alone. So if you made it this far, thank you so much. Please, once again, like, comment, and subscribe. And once again, my name is Michel St. Pierre, and I'm a mortgage agent level 2, servicing all of Ontario, and this is Valhalla Mortgages. If you like my content, I'm going to keep posting videos. You can follow me on social media as well. If you have any mortgage questions, don't hesitate to book a call with me. My calendar link is going to be in the description here of this video. Thank you so much.